Have you ever seen a company's revenue fall, but its profits just shoot through the roof? Well, that's exactly what happened with Syrma SGS Technology's latest financial results. Revenue went down, but profits soared by an incredible 145%. Today, we're going to get to the bottom of this very interesting puzzle.
So this is the big question we're tackling today. How on earth does a company more than double its profit when its sales are actually going down? It sounds kind of impossible, right? Let's unpack the reasons behind Syrma's unbelievable performance.
All right, let's jump right into the numbers. And this first one is a real showstopper. The profit after tax, or PAT, shot up by a massive 145% compared to the same time last year. Just wow.
And the good news doesn't stop there. Profit before tax saw a huge 128% increase. This tells us that the company's core operations are becoming way more profitable.
Then you've got EBITDA, which is another great way to measure operational profit. That's up by a solid 69%. This really paints a picture of just how efficient their operations have become.
But here's the plot twist. While all these profit numbers were climbing, the company's total revenue actually dropped by 18%. And that's the puzzle, isn't it? Soaring profits, falling revenue. How do those two things happen at the same time?
And this chart right here shows that contradiction perfectly. You can see the revenue bar heading down, while the bars for operational profit and net profit are shooting straight up. It's a tale of two completely different directions, and we're about to find out why.
Okay, so it's time to solve this profit puzzle. Let's break down exactly how Syrma managed to pull this off, even with lower sales numbers.
The secret is hiding in plain sight, right here in these two lines: total revenue and the cost of materials consumed. If you look, revenue went down from about 11,700 million rupees to 9,600 million. But at the exact same time, the cost of their materials took a much bigger dive, from 9,800 million all the way down to 7,100 million.
And there it is. That's the secret sauce. While revenue fell by about 18%, the company managed to slash its production costs by a whopping 28%. Because their costs fell so much faster than the revenue, their profit margin on every single sale got a lot bigger. This is the #1 reason their profits just skyrocketed.
Okay, so now that we know how they did it, let's look at where these changes came from. We're going to dig into the different business segments to see how each one performed.
The performance was really a mixed bag across different sectors. You can see revenue dropped in their consumer and IT and railway segments, but on the flip side, they saw some pretty solid growth in industrials and auto. This could be a big clue that the company is shifting its business focus.
Now, even with that drop in revenue, the consumer segment is still the biggest piece of the pie. But you can clearly see that industrials and auto are becoming much more important. So here's a thought. Perhaps the company is deliberately moving away from lower margin consumer business and focusing more on these other areas that bring in higher profits. That would certainly help explain that overall profit jump we saw.
But hey, profit isn't everything, right? You also need to know if the company is financially healthy overall. So let's do a quick checkup on their debt and cash situation.
One of the best ways to measure a company's financial stability is the debt-to-equity ratio. All it really tells you is how much debt the company has compared to the money its shareholders own, and you almost always want to see a low number here. A low ratio is a very good sign.
Syrma's debt-to-equity ratio is sitting at 0.4. Now that is a very healthy number. It tells us that even with the ups and downs in revenue, the company isn't taking on risky levels of debt to fund its operations. For any investor, that's incredibly reassuring to see.
And if you look at the actual figures, it becomes even clearer. The company has about 7,800 million rupees in debt, but they also have over 4,600 million in cash and equivalents just sitting right there. This shows they have a strong ability to manage their debt without breaking a sweat.
So, we've cracked the code. The profit boom came from smart cost-cutting and a strategic shift in business focus. But that brings us to the real million-dollar question, doesn't it? Can Syrma keep up this amazing profitability and get its revenue growing again? Well, only their performance in the coming quarters will give us the answer to that.